Artificial intelligence is changing everything from the way we work, the way we invest, and of course, the way we create content. But here's the $1 million question. How can you actually benefit from AI revolution without gambling on one single stock? Today's video, we're going to be looking at my favorite thing to look at, which are ETFs. Now, these three ETFs that we're going to look at, experts believe will outperform the market in the next 5, 10, even 15 years with the explosive growth that we've seen in artificial intelligence. I want to break down each ETF in here, how it fits in your portfolio, and what kind of risks are associated with it. Now, right now, AI is all the talk. We know it is a mega powerful and really a trend that we've seen in this decade. Now, we've seen it years ago when you think of the internet, then you get into cell phones. Now we're looking at artificial intelligence, and some of these bigger players, Nvidia, Microsoft, Amazon, Google, are investing billions of dollars to invest in this space. And we know right behind that, even maybe 5, 10, 15 years out, we could even look at quantum computing. They are building faster chips, smarter algorithms, new AI-driven platforms. Then when we couple it with computing power, it's going to be kind of crazy. Now, investing into one single company could be very risky. That's the reason I don't like it. I don't like the volatility, the unpredictability of the company. If a company misses earnings or if there's negative news, your portfolio could take a really big hit. Now, this is where the ETFs come in, building that diverse portfolio, giving you exposure to the entire sector versus having one specific stock. And again, we're going to look at three outstanding ETFs that are going to outperform the S&P 500 over the next 5 years. Now, the first one, and one that I personally hold in my kids' portfolio, Vanguard Information ETF, which is the VGT. Now, we know this is one of the most popular and cost-efficient ways to invest into tech and only into that tech sector where we're seeing this AI-driven revolution. Nvidia, Apple, Microsoft, Broadcom, Oracle, all of those with an incredibly low expense ratio of a 0.09, which is great for the exposure you're getting. One of the reasons why we do love these ETFs. Now, because of the layer or really the AI stack and multiple companies out of there, from the chips powering large language models, which we're seeing, cloud servers running them, the software that is using AI, they all fall under the tech industry, where the VGT is going to and really owns the best of the best when it comes to investing. In the past 5 years, it has returned 151% in comparison to the S&P 500 at 85%. So you can see we almost doubled what we created in the last 5 years. And again, we're going to be kind of tagging or earmarking everything to that S&P 500 because that is the market itself. Not all sunshine. No, with the VGT, highly concentrated. 10 companies make up 58% of this ETF. So if you're looking for diversification, this is not the place. So if we see a drawback or a pullback of big tech, this is absolutely going to feel it, having 58% into those 10 companies that are heavily invested in artificial intelligence. So if you believe, just like I do, in AI and long-term growth, this is going to be one that you absolutely want to have. It is one of the cleanest and most diversified ways to play the AI theme. Now, the second ETF we're going to look at is the iShares Semiconductor ETF. Now, this is the SOXX. This is the backbone of AI. These are the semiconductors. This is what is running it. Now, this ETF specifically targets and focuses on chip makers. So when you look at companies designing and manufacturing the brains behind computers, behind every AI system we see, this is exactly what they're holding. When you think of AMD, Intel, ASML, Qualcomm, Broadcom, Micron, all of them are held within this ETF, meaning you have exposure to the backbone of artificial intelligence itself. You're not looking at the front end application or user application. You're more investing in really the key or the foundation when it comes to building this out. Without the chips, AI models can't run. They do not exist at all. Every chat GPT query, every image that it makes, every autonomous car runs on semiconductors. Investing in this is kind of a no-brainer because you are buying kind of the infrastructure. Looking at the last 5 years, this has returned 184%. Again, when we think about the S&P 500 at the 85%, this has grown almost 100% more, which is crazy, even outperforming the VGT that we just talked about. But of course, higher returns come with a little bit of a higher risk. Semiconductors are cyclical. When chip demand drops, it can fall, and it can fall really fast. And if there are more tariffs that are placed, we could see the exact same thing. Now, the expense ratio on this one, a 0.34, so significantly higher than we see with VGT. But overall, when you're under kind of that 0.5%, really doesn't make a big difference. You're almost splitting hairs at that point with the performance that you're seeing. I would rather pay, the 0.25 higher than we're typically seeing to get another 40% return, which is kind of crazy. So when you want to focus directly on these picks and looking at really shoveling out for that AI gold rush, the chip really powers it all. That's the reason why this is kind of a pure play. Now, the third one we're going to look at is the Vanguard S&P 500 Growth ETF. Now, this is a lot different than we see with the VOO. The ticker symbol on this one is the VOOG, which is the growth aspect of the S&P 500. A little bit different because it doesn't focus only on technology, but it focuses on the growth side of the S&P 500. That means, again, you're getting that AI exposure to all of these chip leaders, Microsoft, Amazon, Alphabet, but you're also holding any names within the growth sector when you start looking at healthcare, finance, consumer innovation. So it is not just exclusively to the tech ETFs that we see. Like Vanguard has always done, incredibly low expense ratios. 0.07 on here offers a lot more of a balanced approach and a lot more diversification that still want exposure to AI, but without going all in on tech and with the volatility that it could actually bring. So when you think of a VOOG, this could be treated as the growth foundation, offering stability, diversification, as well as poised to get the benefit from AI when it continues to run. Now, the trade-off from this, you're not going to see those same returns that we see with the SOXX or the VGT that really keeps driving from the AI boom. But of course, when there is a drawback and we know it's going to happen, it's not going to be as bad as we've seen. Now, there is something important. Now, all three of these ETFs have a lot of overlap when it comes to risk, and also from the strategy. When you think of NVIDIA, when you look at Apple and Microsoft, they are across the board. So if you own all three, you could be doubling or even tripling that exposure through the overlap in the same companies. Keep it in mind when you do AI ETFs, they are very top heavy, meaning even looking at the S&P 500, the majority of these large companies like NVIDIA are going to be driving the market itself. We've seen this through all of time. When you look at NVIDIA at, $4 trillion plus, when it goes to 5, 6, 7, these are the companies and the size of companies that are going to be driving the returns for the S&P 500 and the market itself. So if any big tech or when they face some headwinds, a lot of them will move together, even if it is in the direction that you're not looking for. Other risks are, of course, the valuations. People have been talking about this, that tech stocks are incredibly expensive right now. So if interest rates stay high, growth of multiple times could start to come down. But we know right now the Federal Reserve has talked about lowering interest rates, which makes money a lot cheaper. So how do you essentially do this? How do you add them to your portfolio? BGT is the core AI exposure if you're looking for it. SOXX is very high growth, very high risk. So having it at a much smaller percentage, let's say 5%. VOOG, very balanced across all of the growth sectors, could be a foundation 10, 20% of there. Now remember, when it comes to any portfolio, diversification is the key. Don't invite and don't load up everything just AI. Now we know, guys, AI is shaping the global economy. All the companies are using it and they're really growing at a massive growth rate. When we look at all three of these ETFs, you can capture some of the upside without betting on just one single winner. Do your homework, check where the overlap is in your portfolio, keeping that long-term view, which we look at there 5 years plus. If you found the breakdown helpful, definitely hit the like button, subscribe for more investing insights, and comment below, of these three AI ETFs, what do you think is going to be the best performing one over the next 5 years? Do you hold any of these in your portfolio? And thank you guys for watching, and I'll catch you in the next video.